Good morning, good afternoon, everyone. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. On today's call, we've got a few regulars that I think everyone should know well, but we've got Salih Yilmaz calling in from his perch in Dubai, swinging over to Madrid. We've got Patricio Alvarez, and then coming across the pond, we've got Mike McGlone joining from Miami. Let's kick off with the commodity check-in. Just looking, Brent's in the $78 a barrel range. And I think it would be good to check in with both Mike and Solly on where the fundamentals and outlook for crude is at here at the moment. So, Mike, you've got a note out just the other day saying, can commodities drop with hedge funds net short China versus beta? Give us your take. What's the landscape look like? Is oil at sub 80 feel right to you? Where could it go next?
Lower. You haven't heard that from me before, unfortunately. So the macro is overwhelmingly negative for all commodities, and it's a question of what might reverse that, things I can't predict. It's the elasticity forces. The high price cure is just tilting over to low price cures. So obviously crude oil is most significant, but I just point out that what's different from 2 years ago when managed money net positions, i.e. speculators and hedge funds, were way too long near the highs, they're now completely sold out. We've just never had commodities this sold out. We go back to 2011, our data of 19 top commodities, most notably Brent. All those hedge funds are just sold out of their positions. They've never been, even Brent was net short for just a couple of weeks a few days ago. And that's just never happened. And so that's one thing that could get, if we have something that happens that gives us a supply shock, there's not a lot of longs there there's just no, there's not enough shorts in the market. I mean, there's too many. The market's so sold out, it can pop up easily, but it's for good reason. And the fundamentals are just horrible on the back of everything you're seeing now is just what you'd expect from the spiking prices and the elasticity kicking in. We all see the demand declining, and most notably this complete forces of deflation coming out of China, most notably EVs and anything to do with renewable vehicles. They throw all their weight at this, and every country in the world is pushing back in these vehicles. Supply and demand excesses out of the U.S. All my things point to you have to get to that low price cure in crude oil, like we did in U.S. natural gas, like we've just reached in corn. And then copper is kind of dicey about it. I don't see what stops these overwhelming forces pressuring lower. But the bottom line to me is for crude is the macro is the U.S. stock market has to keep going up. And it's so expensive, just simply on a 100-day moving average or a 100-week moving average versus his market cap to GDP. And things like that are just, to me, overwhelming force that the deflationary forces are kicking in. So I'll end with this. The industrial metals index was up about 24% in the year. Now it's down. Bloomberg commodity index was down up about 12% on the year. Now it's flat. On a 1-year basis, the Bloomberg commodity index is down 2%. On a 2-year basis, it's down 17%. And there's only one major commodity that's going up and should continue to go up, and that's gold. And I expect that to continue.
Fascinating. Okay, Sally, let's swing over to you. You've got a note out just yesterday talking about a $75 price floor. And I think that's OPEC's desired price floor. But tell us about your note. It does feel like we are, maybe the whole group is a tad more bearish here at the moment. So give us your sense. What do the fundamentals tell us about the oil market?
Yeah, there's definitely more of a bearish sentiment across the market, I think, for perhaps wider commodities, but especially for crude oil. I mean, very briefly on perhaps why Brent is down below $80 a barrel again. I think in the last few days, the major driver has been perhaps the momentum that we saw in the ceasefire talks, like Gaza ceasefire talks. And, we've been arguing that there isn't really much of a geopolitical risk premium on prices, but it seems like there might be at least a little bit, because I think these headlines have driven oil prices down a little bit. But that wasn't the only driver. Of course, when we look at the fundamentals, on the demand side, I mean, demand is not necessarily terrible, but it's also not great. And I think when we look at places like the US, India, demand has actually been quite decent. But China, where we get a big chunk of the growth, at least we did in the last couple of decades, we're getting mixed indicators, and especially in the last few months, the indicators have been quite negative. So demand, when we look at the second half of the year, the demand outlook is uncertain, but not just uncertain, it's turning out to be a little bit more negative than I think a lot of analysts were expecting. And when we look at supply, it has been a well-supplied market, and it continues to be so. I mean, of course, we have OPEC Plus still keeping that tight grip on supply, but they only cover less than 50% of the market share globally. We have the non-OPEC Plus supply, and there we have countries like the US, Guyana, Brazil, where we're still seeing increasing output levels. So when you look at fundamentals, it's looking pretty soft. And the current plan by OPEC Plus is to start bringing some of those barrels back into the market starting in October, but that really just assumes demand continuing to grow significantly from their current levels, and perhaps non-OPEC Plus supply not growing enough to match that. But it's starting to look to us, and I think to everyone else in the street, is that any marginal demand growth from here will probably be met by non-OPEC Plus supply growth, which means there's really very little room for OPEC Plus to bring any barrels back in the fourth quarter this year and potentially early next year. So I think OPEC Plus does find itself in a very tough spot. But all that being said, we do think that there is still a floor, because as difficult of a position as OPEC might be in right now, they still have an active supply management policy. They can extend these cuts well into year end and potentially into mid next year if they need to. I mean, I think in the last couple of years, they've shown that they can and would do that. So I think that's one of the main reasons for why we would have a price floor. We think at around $75 a barrel. And also, geopolitical risks haven't really gone away. I mean, we talk about Middle East, but also we still have continued tensions between Russia and Ukraine. And when we talk about Russia and Ukraine and the Middle East as well, perhaps the market has been getting a little bit complacent because we have not had any major supply disruptions, but that does not mean that we won't. So the risk is still there. And the market doesn't really seem to be putting much of a premium, at least as things stand, on prices. And just very final note, and I know we talked about this last week, but we do have our oil fair value model, and that model currently is telling us that fair value may still be in the mid 80s, and this is despite refining margins, which is a big factor in our fair value model. Despite refining margins dropping quite a bit from the levels that we saw in the first quarter.
Thank you, Salih. And after the call, we'll make sure to follow up with links to some of the research. But you've got a really interesting chart that was a collaboration with our colleague on the eco side, Ziad, and geopolitical risk premium near zero amid ceasefire talks. So I encourage everyone to take a look at that. And Patricio, that's where I want to bring you in, because it does seem like, at least if you swing over to the gas market in Europe, it seems like there is geopolitical risk influencing that market. So very limited geopolitical risk in the oil market, strangely here at the moment, or at least it seems very copacetic about the risk. What do you see in European gas? I would just note just quickly, gas is just sub 40 euros a megawatt hour, so quite higher than it had leveled out at for a bit. So what's going on there?
Sure. So just for context, we do see a diminishing, let's say, supply risk premium on European gas this week. So European gas is actually down about 2 euros since the start of the week. which is kind of following the same trend as Brent oil, and it seems to be because of these ceasefire talks in Gaza, and also I think it's just reports that gas flows via Sudkha in Ukraine have not stopped. So those are residual Russian flows that are still flowing despite the fact that Ukrainian forces took over that transit station, which is something that we did flag on our React a couple of weeks ago, that we didn't think that these supply risks were going to materialize in actually swaying the fundamentals in Europe, and we still see flows coming in, and I think that has somewhat alleviated the market concerns. We also we've read reports today that Goldman Sachs is saying that the recent rally in European gas prices has been overdone. So we think that's acknowledgement that perhaps the fundamentals may take hold in the near term, and that brings us to, okay, we acknowledge the supply side. We think European gas balances are well supplied outside of the risks that we've just flagged. But on the demand side, gas demand in the first half of 2024 has actually declined another 3% after declining 14% in 2022 and 7% in 2023. So that would take 2024 demand back to what it used to be in 1984. So that's a 40-year a multi-year low, sorry, a 40-year low for European gas this year. And if you couple that with the fact that storage levels are 90% full at the moment, which is roughly 10% above the long-term norm, and just in line with what we did last year, there are very few reasons to believe there's any demand upside this year. Renewable power is reaching new heights, so that is set to displace some of that gas-fired capacity, and I think that perhaps this like 37 to 38 euro per megawatt level is being supported by a near-term increase in temperatures as well. So we've seen above norm temperatures across most of Europe, and I have the chart with the weather forecast in front of me right now. It seems like the next 2 weeks are also going to be a couple degrees above the norm, so that may support I think pricing and demand in the near term. But overall, the demand picture doesn't look great for the next 6 to 12 months.
Mike, I want to swing back around to you because you mentioned gold, and I know we tend to focus on the energy commodities, but gold's not a one I think about very often. And I just pulled up the ticker on the terminal and did the max. So from 1920 to present, it's quite an interesting chart. I intuitively wouldn't have guessed that. Gold to me feels like an old economy kind of thing. What's the senator there in New Jersey, or former senator, one who was sort of with the gold bars? So it just gold seems like something that's like a quaint thing that, back in the day it was sort of a proxy, a real currency, but now it's sort of just this rare metal. Why has it been going to town here lately?
Well, I appreciate you going there, partly because as a commodity person, it's the only one I really see going up and still going up. Copper might go a little bit there, certainly not crude oil, unfortunately, because of what's happening with global shifts and elasticity and just rapidly advancing economies and technology. The key fact about gold is on a 1, 2, and 3 year basis, the rock is beating the stock market. It's beating the total return S&P 500. That's a very disconcerting sign. So here's the facts of all overall commodities in gold. When the Bloomberg Commodity Index peaked in 2022, since then it's down about 30%, and gold's up about 30%. That's a global deflationary trajectory, and gold's picking up on that. Now, I'll end with one key level, not end, but I'll point out. 2.17% is the yield on the Chinese CGB, Chinese 10-year note yield. That's what, 160, 70 basis points less than the US. Typically in history, it's been much higher than the US. China is clearly heading towards a normal reversion of a rapidly advancing economy that was a decisive enabler of a war in its neighbor's backyard. The world's getting out of China as much as possible. It's a complete shift. That was a quote from NATO, by the way. So to me, that's the macro paradigm shift, the elephant in the room that cannot be ignored. And gold's just picking up. The largest buyers on the planet of gold, it starts with China, are central banks. And why? Partly because they see they're trying to get out of the dollar, but that's part of that tilt away from China, the most significant demand pull source on the planet for industrial metals and commodities, and that's why I'm still quite bearish. And so to me, that's the key thing. Is I'm just doing a little bit update comparing the right before 2007 and 2008. At the end of 2007, WTI was around 90 and change a barrel. Now it's 73, and gold was pushing around 1,000. Now it's 2,500. You see the trajectory? It's just what happens over time. You can go back 100 years. I've reread a little bit of Wealth of Nations by Adam Smith talking about commodities, and gold's mentioned, crude oil wasn't, because it didn't exist back then. But it's just what happens over time. Gold almost always outperforms all commodities on a total return basis. It's just a question of time, and partly because what it is. It's much more of a monetary asset. So I don't see what stops that. That's the key trajectory I look at: is gold up, commodities down, gold up, crude oil down, gold up, industrial metals down. The velocity of those moves right now very similar to the great financial crisis. This time it's global. So I just want to end with one thing: is just some of the facts that Salih and I will coordinate earlier. But one thing I've been noting in the U.S. is declining demand for petroleum. I'll lead that over right now. So diesel demand in this country is down like 7% from the peak. It's down 5% from the bounce in 2022, and it's the same as it was in 2013, over 10 years ago. It's never happened in this country. That's what's happening in the world's largest demand pool economy. Even unleaded gas demand is down 4% from the peak. And why? Because prices spike and we're finding alternatives. You and I drive EVs, and a lot of us go to work less. So to me, that's the shift in the world, and it all favors gold in terms of commodities.
But Mike, I almost want to push back a little bit, because part
Please.
of your thesis there is that interest rates are part of the factor, or Fed decision making is part of the factor that is supportive of gold. But shouldn't oil, in some sense, kind of theoretically respond in the same way? We often think of oil as kind of having an inverse relationship with what's going on with interest rates. Why is it different?
Paradigm shifting commodity. 2008, the paradigm really comparing to, U.S. was the largest importer of crude oil, around 10 million barrels a day. Now a net exporter, largest exporter of LNG, largest exporter in the world of grains. A lot of it's just adopting the technology. It's a paradigm shift that's going on in the world. And the world's largest demand pool part, China, is clearly heading towards a deflationary recession, potentially depression, way overdue. So that's the thing. Crude oil just doesn't matter in terms of that anymore, unless it goes up a lot. And when it does, it just the best example in history was, as Alan Binder called it in his book, I'm reading it right now, The Monetary History of the United States, 1961 and 1921. He called it OPEC 1 was 1973, 1974, and OPEC 2 was 1979. Since 1973, the world's onto it. Every time crude oil spikes, it goes down harder and farther. It started maybe tilts global sense. They hurts global economic activity. People find ways around it. And that's just accelerating now. It's just delayed, I think. That's why I think it has to get cheap. Cheap has been below around $40 a barrel since 2008. But it's the key thing is the replacement. We just don't need it as much anymore. It's going the way of whale oil. And I'll just end with this. Peak demand for crude oil is around 2005 in the U.S. It looks like it's hit there in China, maybe close. And one best way to get peak demand is to have a little spike in prices.
Okay, thanks, Mike. Salih, I want to get your read on this as well. I believe that interest rates are one of the inputs into your fair value model. So tell us how you think about the interplay here.
Yeah, I mean, I don't really disagree on much of what's already been said, but of course, on the demand side, as interest rates are cut, I mean, I should say, in the last couple of years, as interest rates rose, we've been talking about how this is going to be bearish for demand and it's going to keep demand in check. And of course, now the reverse. I mean, if it looks like we're going to have a soft landing, and if there's now a path to have rate cuts from now onwards for the next couple of years, that should be positive demand. But perhaps the difference, and I don't know too much about gold, but when it comes to oil, of course, that's only one side of the equation. What I was alluding to earlier, of course, where supply is very important. And I think we've written on this a couple of months ago, is that the OPEC plus strategy that we've seen in the last couple of years of chasing higher prices and not caring as much about market share, of course, this has helped them keep prices higher. But perhaps the side effect was that these high prices also subsidized a lot of non-OPEC plus production. And you and I, Rob, we worked on a bit together on how, on this, creating this chart of how market share of OPEC has come down quite significantly, while the market share of US and Brazil and Guyana rose significantly. So again, like you might have demand perhaps getting a little bit of support as rates go down. And I mean, you can argue how much of an impact that would have, but as long as there is plenty of supply, and I mean, just OPEC, just core OPEC countries are sitting on more than 6 million barrels per day of spare capacity right now. So, you know, there's plenty of supply as things stand, both within OPEC and outside of OPEC plus. So we can't really be thinking about just the demand side. We also need to be thinking about supply. But generally, you know, I would say that concerns around the global economy, concerns around high interest rates have been one of the main drivers of perhaps lower, I mean, have been one of the downside catalysts for oil prices. So when that turns, I think it's only fair to assume that is going to be one of the bullish catalysts. But I mean, as Mike was saying, and as we have our oil fair value model set up, there are many moving parts, and I think these are just a couple of the drivers for the oil market and oil prices.
Fascinating, Salih. Okay, so I'm going to try to thread the needle here to bring Patricio back in, but sort of the path I'm going to take you on first is, so Mike, I'm just looking, in my mind, I think gold and silver are often quite correlated, but I did the long-term chart on silver as well, and it doesn't quite have the same look as gold, but like in recent history, there is some alignment. And the reason why I want to check your pulse on silver is, if you know much about the solar business, silver is actually an input into making solar modules. And solar modules, if you look at the price of those, it's one of these, it's kind of got like a Moore's law kind of thing. Microprocessors have gotten way cheaper through time. Solar modules, you know, over the last 15 years, module prices have declined, you know, 90% or something like that. And so you've got this energy source that just, the technology keeps improving every year and getting cheaper and cheaper. That being said, since silver is an input into that process of creating solar modules, let's just get a read from you. Do you see silver as aligning with gold? Do you think it has any sort of fundamentals there as well?
The questions are the same. The answers have changed. Silver is an industrial metal. It's been demonetized by gold since Sir Isaac Newton was the head of the mint in the UK. And what's the ratio now? Like 86 ounces, used to be 16 ounces per 1 ounce of gold, something like that. It's can go up. And silver almost always underperforms gold when you have the US yield curve bottoming, US unemployment bottoming, the world heading towards a bit of a recession. It almost always underperforms. That's what it's doing. And to me, I put it in the same bucket as copper now. I look at copper has got a big problem. Just look over at yields in China. You mentioned solar. Well, you got to go straight to China, who's creating the massive amount of excessive energy coming on the world from solar panels and renewables and EVs, all coming from China. Yeah, they use silver, but I remember hearing that argument 10 years ago when silver really basically just replaced the amount of photography that was used for demand. And it's just one of those. Yeah, so solar's what, 10% of total demand? I just haven't looked at that close lately, but I see silver as maybe catching up a little to beta in the space. But virtually all commodities are falling behind gold, and silver is just one of them. Typically, it's called leveraged gold. But as Salih mentioned, once we maybe get an environment and rates, U.S. rates are coming down hard, silver will catch up, maybe. But you need some demand pull sources in terms of industrial economic activity from the rest of the world, and they're all going the other way, i.e. go back to those bond yields in China, and they're plunging for a reason.
Okay, so thank you so much, Mike. Patricio, let's come back around to you, and I'm curious to get your read on the European power market landscape. You talked about your view on the gas market, and I'm just curious as to how the European policymakers are thinking about clean energy. Like, does the price of solar panels or wind turbines, does it even matter? Is it sort of a paradigm where someone has said, thou shalt install wind and solar, forget what the economics tell you? Do any of these things kind of come onto the radar in Europe? And I'm curious a little bit, particularly because, as you're aware, in the US, we do pay more for our solar panels than you guys are paying in Europe because of tariffs and because of the Inflation Reduction Act. We're paying closer to 30 cents a watt, whereas in Europe, much more around 10 cents a watt. You know, they're both way lower than it was 15 years ago, but what's going on with the pricing dynamics around clean energy in Europe?
Yeah, so that's a great question. I think one place to start it or to looking at it is that Europe is flooded with Chinese solar panels, and I think that it has helped the adoption of these technologies, not only for the economics of utilities that are tasked with deploying them, but also you can see it in the rates of adoption for decentralized energy. So people installing them in their own homes and in their in their own houses. So I think regulators are now a bit concerned that this actually did hurt the local manufacturers, solar manufacturers in Europe, and you are aware of that because you cover that sector very closely. But I think regulators are now concerned about what it's doing to the wind industry, and you've already seen a couple of wind manufacturers struggle quite significantly in Europe. So regulators are tasked with kind of, I guess, following suit or following the similar path as the U.S. in trying to take protectionist measures. But I think on the overall, like if you look at the energy landscape, not only from the tariffs and trying to protect your manufacturing base, but from the access to actual resources, I think Europe is in a completely different sort of context than the U.S. So Europe is I would say it's a net importer of energy of all sorts, so oil and gas. All of their reserves are declining. So renewable energy is not only something that I think policymakers want to see increase because it's good for their platforms, but it's also because it's the only option. So Europe has already mandated the closure of its nuclear plants. By and large, there are a few countries that are still set to install a few reactors over the next decade or so. But overall, if you see capacity is largely flat, it has been largely flat for the past 20 years. So that makes renewables like wind and solar sort of the only option for Europe to start sort of bringing those energy costs down, because importing gas has proven risky, as the Russia Ukraine conflict has proven or proved in 2022, and I think overall that makes the direction of travel for policymakers still focused on the energy transition, still focused on modernizing grids and trying to improve the cost efficiency of grids. So overall, I think Europe does face a different landscape because it's a net importer, and there are very few alternatives, I'd say, to lower the cost of energy production here.
Okay, fantastic. So we've got a question from the chat, and for anyone who's listening, you're always welcome to pop a question in, and if we don't get to it, we'll follow up afterwards. But I think this one can really be relevant for the whole group. So I'm just going to read it verbatim because it's a good question. So given the deflationary forces you're discussing, particularly with commodities like crude oil and industrial metals facing downward pressure, how do you see these trends impacting small cap companies, especially those in sectors like energy, materials, or industrials? Salih, I know you cover mega cap Saudi Aramco, but you've got a diverse portfolio. How do you think about the smaller oil and gas names and refining names that you have under your belt? What do you make of how they're going to fare in 2H and beyond?
Yeah, so I mean, this might be specific for my coverage, but as you said, I have a few. I mean, I have a company called Aramco that's has the size of about $2 trillion, which I would categorize under a mega cap. But I do have a few European refiners which are much smaller, between $1 to $5 billion range. So I could perhaps speak about our outlook for these European refiners and perhaps the outlook for refining in general for the second half and next year, given this current energy landscape. And we've talked about our expectations for crude oil, and of course, crude oil is the feedstock for refiners. But of course, for these refiners, the market balance for oil products, which are the products that they sell to the market, is very important. So what these refiners saw in 2022 was extraordinary margin levels, margins that were in the $20 a barrel range for most of the peer group. And that was, of course, because of the disruption created by the Russian invasion of Ukraine. And since then, of course, the market, new routes opened, and the market kind of rebalanced. And margins started normalizing. But then what we saw in the first quarter of this year was very resilient margins for this peer group. And that was driven by the Middle East conflict and the turmoil that we saw in the Red Sea, where a lot of vessels started avoiding the Red Sea and going around Africa, longer journey times, higher fuel prices, higher refining margins. But we've been arguing in our mid-year outlook for these refiners is that these margins are going to normalize. They're going to normalize toward their 10-year averages, which is in single digits. And that's exactly what we're starting to see. What we saw in the second quarter earnings reports, both in these pure refiners, these small cap refiners, but this was also reflected in the big oil majors and their refining segments as well. A sharp drop in the second quarter. Now we don't have as much of a supply squeeze for these oil products. We have some new refineries, especially in the Middle East and a couple in Asia, that are producing more fuels. And demand, as I was talking about earlier, isn't quite turning out to be as strong as the street imagined at the beginning of the year. So you combine these, it's a much looser market, which means lower prices, which means lower refining margins. Again, these are small cap refining companies, quite specific. I think the question, I was just reading it, is for perhaps a wider set of sectors. I think they mentioned industrials, etc. But I could only speak really for my coverage, which is pure refiners in Europe. And that's our expectations for the second half.
Okay, Mike, I know you don't look at equities specifically or single name coverage, but any thoughts on the sort of small caps in the spaces mentioned?
I look on the macro, and one thing I published recently, I like to point out, historically, if you want to have exposure to commodities, and the best ways to do it is can actually buy the actual metals. Gold can usually buy ETFs to track the gold, and it's probably never historically probably never a good idea to actually try to buy an index that tracks crude oil, but the equities that produce crude oil, anything related to that. So XLE is one thing I watch in that space. But the key issue is right now is this is a normal cyclical deflationary cycle in prices. The price on this screen right now for WTI crude oil was first traded in about 2006. And right now it looks to me like it's just accelerating that way lower. And the bottom line, like I said early on, is we mentioned equities, is when you have the US stock market this stretched, it has to keep going up. That's beta, and just a normal correction beta means that the deflational dominoes tumble, and that's what I'm seeing in rising gold and falling, and that's falling U.S. government bond yields and bond yields in the rest of the world.
Okay, fantastic, Patricio. Over to you.
Yeah, so in my sector is a bit harder to dissect. I would say it's the small caps from the large caps, just because I think if you look at the recessionary sort of outlook that you've just described, that tends to just be broadly supportive for utilities. But that said, I think given what's being configured for next year, which is sort of a slowing economic growth, at least in Europe, there will be a bit of a recovery. So but still fairly tepid economic growth. So you have sort of recessionary forces plus the potential easing of interest rates. I think that vote will probably bode well for companies that have suffered quite a bit this year. So when looking at the smaller caps, we look at the renewable developer names. So you look at your EDPRs, your Accionas, and your RWEs, where the value of the renewable assets is very much impacted by interest rates. So that perhaps could be sort of a tailwind for them next year, given that renewables are long-term contracted and tend to be they're not exposed to commodity prices, which, as Mike said, are going to probably go down next year. And then you have your group of pure play grid companies, so your Ternas and perhaps your Snam or your Italgas, which are the regulated utilities. Those also are quite sensitive to interest rates, and as you know, they have this like stable growth EPS profiles and relatively lofty dividend yields. So I think those are sort of the companies that could be interesting to look at moving forward.
Okay, thank you, Patricio. Just quickly for me, I think in the solar space, I've talked about it previously, but go check out our focus idea. The decline in module prices has essentially created a super competitive market in the solar space, and we're really seeing margins at a lot of the companies get very eroded this year. And so if you look at First Solar in the US, I suppose they're a mid cap. They're certainly not a mega cap. I don't think they're quite a small cap. But if you look at their profit generation, we think they're going to generate more profit than the three largest players combined. And the way to think about that is First Solar represents less than 3% of module market share globally. So it's a pretty small player. And then if you take the three largest players, which are all in China, so Jinko Solar, Longi, JA Solar, combined, those companies supply 50% of the market. So you've got a little tiny company, less than 3%, and then take that and compare it against the three largest companies, which is half the market. And that one little tiny company, First Solar, we think is going to outstrip the profit generation from the three largest players. Now, why is that happening? Well, it's the tariff story, it's the Inflation Reduction Act. The company is protected, but take a look at that. I think in general, you're seeing the decline in module prices be a pretty big headwind for most of the players, unless you have some special carve out that's probably going to be related to policy. So go check out that note. And just quickly, I will flag again, because we've got this cool flagship event coming up in Houston in just a couple of weeks at this point, or 3 weeks, I believe. So September 10th in Houston. We're going to talk about the intersection of AI and energy demand. We've got some great external speakers who are going to be joining us to really help bring that theme to life in the market. And if you haven't been following Patricio and I, we've been writing a lot on this topic. It's very cool. We've entered this world where electricity demand had been sort of flat, declining in a lot of Western markets. And finally, we've got this catalyst that has the potential to drive growth, which is basically AI data centers that are being built rapidly to help meet the needs of the so-called hyperscalers. So it's Alphabet, Meta, Amazon on down the list. And so please check out that event. If you are in Houston or Texas generally, come down and see us. It's going to be really fun. And with that, I think I'm going to leave it there, but feel free to reach out, shoot us an IB, talk to us about any of these topics. We're always happy to engage, and we thank you for joining us and look forward to being in touch. We'll talk to you next Wednesday.